Good evening, and welcome once again to Public Perspective. I'm your host, Kevin McDermott, and tonight we'll be delving into the arcane subject of high finance. Don't be alarmed. We're going to talk about it in terms that everyone can understand. Our guest tonight is Mark Shore, who's the Chief Research Officer at Shore Capital. Mark, thank you so much for being here. It's a pleasure.
Thank you.
And pretend I'm one of your brand new students at DePaul, and so you're going to have to walk me through this in a very elementary manner. So you're here tonight because you are a specialist in alternative investments. And most people don't even know what investments are. So what is alternative and why does it matter?
Okay, so if you think about it, well, start with what are traditional investments. Usually people refer to traditional as stocks and bonds, so therefore alternatives could be almost anything else. Oftentimes referred to as private equity, hedge funds, managed futures, currencies, commodities, physical infrastructure, real estate also falls into that. So you've got this huge spectrum of menu choices, you might say.
So really anything that's not a stock or bond. And actually, I bet most people don't know the difference between stocks and bonds.
That's a possibility.
Right.
Yeah.
So, but anyway, they've heard of them. They know that in their portfolio, their 401k, there are stocks and maybe bond funds. But this is anything that's not one of those two, right?
Well, they can be trading, like in hedge funds, they can be trading stocks, or they can be trading fixed income, it could be bonds, but it's also what are they doing with it? If you think about it, so like in a mutual fund, well, they just go long stocks, right, and just sit on it.
And by going long, remember, our audience, so that means you actually hold the stock. You own it.
Yes, you own it, you're buying it at one price, you're waiting for it to go to a higher price, and that's how you profit from it. Here, there's all sorts of different strategies that they may do. So if you just look at, say, with stocks, they could be going long, buying it. They could also be going short, which is you sell it first with anticipation it's going to go down in price, and then you buy it back at a lower price.
So you basically borrow it. You sell something you don't own when you're selling short.
Yes.
Right? With the expectation that you can be able to buy it later at a lower price and fulfill that order. Right.
Right. So you can do that. So that, and you can do that with stocks. Obviously, you can do that with futures. My world is really more of the futures world. So
explain what a future is.
So
what a future? We all know what the future is, but in finance, what are futures?
So futures contracts are contracts that are based on underlying investment or asset. Let's say corn futures. So so you're looking for what the price of corn is going to be at, say, expiration of the contract in December. So it's trading now. You know, it trades at an exchange, a futures exchange.
Like in Chicago at the Commodities or the Board of Trade.
Yeah, Board of Trade, Chicago Mercantile Exchange, places like that. And conceptually, you're doing the same thing, right? You're either thinking the price is going to go higher or it's going to go lower, either direction. And so the contract is really just reflecting what is happening or the anticipation of what's going on in the underlying spot market or cash market. So for corn, the actual cash market for corn. You can do it with gold, crude, a lot of different commodities.
So my understanding, as basic as it is, of futures, is that this was really something developed for primarily farmers or people who needed to lock in prices of raw materials, be they farm materials or gold or copper or whatever, because they're going to need it at a certain time in the future. And they, for manufacturing purposes or for whatever. And so they would buy these futures contracts to lock in a price that they could exercise later, and that way they would be able to control their production costs. Is that the correct understanding?
That's part of it for the end user. The other side is for the producer. So let's say the farmer, right? They're looking to sell it. In fact, there's a story behind with the Chicago Board of Trade, which, if you think about it, if you want to use that as the example for futures trading in the U.S. as to when it started, so roughly about 1848. Prior to that, you would have farmers that would bring their crops to market, bring it to Chicago, try and sell it. There was a lot of price volatility going on in the grain markets. And if they couldn't sell it, they would either dump it into Lake Michigan or they would put it on fire. And then basically, so you would have this shortage of supply, right? This very cyclical volatility of pricing going on. So a group of farmers and merchants got together. They started the Chicago Board of Trade in 1848. And that eventually, it wasn't a futures contract, it was really more of like a forward contract, but then it eventually turned into what we know it today to be more of a futures contract.
Which is about a specific date in the future when this price would be exercised, correct?
It's the price, or it's the time, it's a standard contract as to what the grade is, what the actual delivery is.
What the amount is.
Yeah, the amount, the pricing, all of those combined. And then there's also a margin, right? You have to have a certain amount of dollars that you put up for it. So it's usually a small percentage that you need. It may be 3%, 5%, 10%.
So now so people understand the mechanics, the exchanges actually create these contracts, like they define what the contract is going to look like, correct? And then the traders, both sides, understand that this is, as you mentioned, a standard contract. So everybody knows that this is what one contract looks like, has the same characteristics, whether it's one contract or 1,000 contracts. Each of the contracts is the same structure.
Exactly. It's standardized. There's specifications to the contract.
Yeah. So we got a little far afield here, but you're starting to talk about alternatives. So futures are an alternative investment?
That's part of it, right? So with futures, you can trade commodities. You can have exposure to financial futures, such as stock indices, bonds, like treasuries, things along those lines, currencies. So there's a very wide selection that you can just trade within futures that gives you exposure to these different markets. And if you think about it, there are managers out there referred to as CTAs, not Chicago Transit Authority, which some of my students will sometimes think about.
What does CTA actually say?
Commodity Trading Advisor.
Gotcha.
So what they are is they're a professional money manager. They're trading the futures markets, and they have a fund. You invest in the fund, or it can be what's referred to as a managed account. So it's an actual account that you're giving power of attorney to that manager to trade futures. And what they'll often do is trade multiple markets. So some of those markets, they may not be trading at all at a given time. Other ones, they may be going long, looking for it to go up. Other ones going short, looking for it to go down. And ideally, they've created a portfolio in doing this. And then ultimately, it's what's the return of the portfolio?
And that's what, well, the alternative investments, and I remember reading about this some years ago, the managers of the endowment funds for some of the Ivy League schools, Harvard, Yale, were in the news because they really had diversified into these alternative investments, and they had actually written articles, I think in one case a book, about it, and that they were getting much higher returns than people who were just in the stock market, for example.
Yeah, and what it does, it does a few things. So one is it reduces your so-called tail risk. So if you think about it, that 5 or 10% chance of something happening, right?
Something bad, yeah.
Right, that so-called black swan,
Yeah.
the so-called event that's supposed to happen once every 100 years, that probably happens maybe every 3 to 5, 10 years.
Right.
And
everyone seems shocked and surprised that it happened.
Every time, yes.
Right, every time, right.
But yet it keeps happening. In my career, I've seen it happen several times. But yeah, so it's those tail events that this can help you with, because they are, these investments can be non-correlated to stocks, which means that it has independent source of returns. It doesn't necessarily go up when equities go up. It doesn't necessarily go down when equities go down. There are times when it does, times when it doesn't. So it becomes more non-correlated.
Right.
So it's not positively or negatively.
Right, which is, and for those who aren't familiar with correlation, something that's correlated moves in the same direction, not necessarily by the same magnitude, but if it's correlated, if it's correlated to something, if that something goes down, then what we're talking about goes down. If it goes up, it goes up. So when it's non-correlated, it's an independent movement, right?
Exactly, yeah. So give you an example of this. So earlier in my career in the late 90s, I would travel around with wholesalers, going around and talking to investors and explaining managed futures, alternative investments. And if you think about, well, what was going on in the late 90s? So equities were rallying big time, right? Everyone was jumping on that bandwagon. So I would talk to some investors, and they would say, no, I'm very well diversified. I've got technology stocks, healthcare stocks, financial stocks. What do I need you for?
But they're all stocks.
Exactly. And when you have macro themes that occur in the markets, such as what happened early 2000s, what happened in 2008, all these stocks will tend to move together.
Regardless of what industry they're in.
Exactly. Yeah. And that's what we saw, right? All of these things were moving in tandem and basically all heading south, all being sold off. So if you are long, you're owning these stocks, well, then question is, okay, everything's moving against you. So what else can I do to try and diversify the portfolio? So you have to go beyond stocks and bonds. And so by having some alternatives in your portfolio can potentially help you with that.
So an alternative in this case would be you mentioned shorting stocks earlier, so you could have shorted things, but for those who are wary of short situations, you could just own different asset classes, right? Like real estate or any of the other alternative investments you're talking about, right? That were uncorrelated and wouldn't necessarily sink, might even rise in a declining stock market, right?
True. Real estate in that
In
situation,
that, well,
particularly,
in 2008,
yeah,
that would have been a bad, a bad hedge.
that was
Yeah.
heavily correlated to
Yeah.
the economy.
Yeah.
So, but if you look beyond that, there are other things out there, and particularly if you're looking at exchange-traded products. So it could have been with futures. It could have been with traders who were doing different strategies with equities, where they could have maybe not stopped the sell-off, but maybe kind of softened the blow a bit. So there's different things that could have occurred. But that's the idea, that it's in that portfolio, or in your portfolio, to try and help smooth out those moments.
So is that more important when, for example, when you're talking to a client, is it more important in your sales presentation to emphasize the smoothing out of the volatility and the lessening of the risks of these tail end, without going into what a distribution is, but
Yeah.
these rare events that can be really bad? Or is the overall return better? Or are those essentially two sides of the same coin?
No, what you're really doing is you're looking at this from a portfolio standpoint, right? So in a portfolio, you could have stocks, bonds, hedge funds, managed futures, commodities, currency, real estate. You could have a lot of different things in there. The question is, what's the goal of having each of those in the portfolio? What does it do for you? Some are more geared towards returns. Some are more geared towards preservation, to reducing, to be a shock absorber.
Okay.
I mean, some people think, well, fixed income can do that, and to a certain extent it does, but not necessarily enough.
And in 2008, fixed income got clobbered right along with stocks.
Yeah, so you've got to think about, well, what else do I put in the portfolio? And no one has a crystal ball to know what's going to happen down the road.
So give me an example. So let's take 2008 as the example. In someone who thought they were diversified and had a bunch of stocks and even diversified into bonds. Now, we know the bond market got, in fact, that's where the contagion started, was in the bond market.
Well, mortgages and things like that, that's where
Mortgages.
the problems, yeah.
Right. So the debt markets collapsed or froze, and the stock market collapsed as a result. What asset classes would your clients have been in that might have softened that blow?
Well, to a certain extent, it wasn't so much which classes they were in, which asset classes, but what were they doing within them.
Okay.
Because also you had commodities also heading south. If you think about it too, when economies go in contraction, when economies go in contraction, you're going to see commodities also a lot of times get reduced in pricing. But if you were short those markets, that helped. And you had managers that were short, or when there's shocks to the system. That when you get these shocks to the system, that's when you see volatility kick in, right? And oftentimes, and that's so-called downside, volatility, negative volatility. So you have that going on, but in that time, you have other strategies, other investments that can be offsetting it. So if someone happened to be short equities, or they were short commodities, or short crude during that time, that would have made them money. If they were long gold, that would have been helpful also. So there were a lot of different things going on, but as I mentioned, some of these managers, they're trading multiple markets. So they may have been short commodities, they may have been long gold, they may have been doing various different things. Some of them also are more what's referred to as systematic traders. So it's computerized trading. It's that so-called black box.
Right.
I used to develop some of those years ago. They're also not as complicated as people make them out to be. It's not rocket science a lot of the times. Some are, but a lot of them are actually relatively simple. But it's the idea that there's something that it's a catalyst in the market. There's a triggering point, and then the system says, okay, go in and either buy or sell in that market. And but when you get these shocks, that's when you start to get a lot of volatility. You can get large movements, and that's where potentially you can make your returns, and it can help with the portfolio.
So when you go in to advise a client, and let's talk a little bit about who your clients are. I would guess that they're institutional investors, not individuals, or is that not correct?
My clients, it's more of B2B.
Business to business.
Yeah, so I work more actually with the exchanges, the brokerage firms, the money managers. I write research, I talk about it, I teach it, but it's really to help explain more of the markets, explain more of the products, the services, why this potentially makes sense.
Why an alternative investment strategy makes sense. Right? And then do you also look for good models, like you find managers who are doing creative things with a combination of shorts and longs options as well? Do you look for those kinds of things and then try to formalize that?
Yeah, part of it is, actually not part, a lot of it's actually about the risk management. This is something too I teach the students, because a lot of times the students at the beginning of my class, DePaul University is on a quarter basis, so it's 10 weeks. When they walk in at the beginning of the quarter, they think, oh, it's all about the returns and nothing else matters. It's like, okay, well, yeah, returns, it's part of it. It's one of many components. But it's also about how do they manage the risk. Once they put the positions on, what do they do to protect it? How do they protect it? There's something referred to as a drawdown, which just, it's losses in essence of your value, but it's saying how much did it draw down, right? How much did it come down? And you try to use that as a gauge to get an idea as when they go into a drawdown, how often does that happen? How deep does it tend to be? How quickly can they come out of it? So that's a recovery, right? Recovery is measured in months, drawdowns is measured in returns, negative returns. And you use that also as a gauge to see how well they can come out of it. I mean, every investment goes through its moments of drawdowns, but how well do they protect it? Or is the portfolio protected?
And in alternative investments, I assume, you talked earlier about there's a part of it that is really geared towards this protection. Now, something as simple as if you're in stocks, putting stops, which are just an instruction to sell if a stock reaches a certain price. I mean, that's not an alternative investment, but it would be a hedging strategy, right?
Well, it's part of your risk management.
Yeah. Okay.
So, and you see plenty of other managers that do that too, and I see that with CTAs, with and in hedge funds too. They may put in stops in place. So if it hits it knocks them out. It's very disciplined. You're not sitting there and it hits your price, and then you're thinking, oh well.
Should I really?
Yeah. Especially if you're a systematic trader, it's already telling you where to get out. So you should have that in place. And it becomes very systematic. You take the loss, you move on to the next trade. And it can help you to keep your losses smaller. Ideally, there's an old saying about cut your losses short, let your profits run.
Right.
And I learned that when I started on the floor of the Chicago Board of Trade. Much easier said than done.
Yes, I'm sure. Buy low, sell high.
Yeah.
Much easier said than done.
But conceptually, that's what you're trying to do. You're trying to protect the downside, trying to keep the losses to a minimum as much as possible. And that's when you start to see that in the aggregate, in a portfolio setting, that's what you see the drawdowns, what they look like, and to measure the drawdowns.
So let's come back to the idea. You've talked a lot about portfolios, and in classic portfolio theory, having gone to a similar business school to the one you went to, so it's all about diversification, which you mentioned earlier. And the classic diversification is different industries, different stocks, but it's really focused on equities, stocks.
Yes.
And diversification, and talking to you, I think now it's not even just different markets, as you mentioned, it's different strategies. So you have to diversify amongst strategies, right?
Yes.
So as an individual investor, like someone who is at a company and they have their 401k through the company, does this thinking help them at all? How would they take this knowledge and do something different?
It depends on what choices they have, but ideally you're trying to think about what do you have in your portfolio, how correlated is everything, right? And if you think about correlation, oftentimes people will take like a snapshot number, let's say over a 10-year period, and say, okay, a correlation between these two investments is 0.3 over a 10-year period. Great, but what happened in between the 10 years? Like over a 6-month period, a year period, a 3-month period, does the correlation still stay at that point? Chances are there's probably moments where it becomes highly correlated. There may be moments where it becomes negatively correlated. Or it just stays highly correlated too, especially in moments of shocks to the system. So what you're trying to do is reduce that correlation risk, right? So just, even if you're just looking at stocks, just take a look at it and say, well, how correlated have these stocks been, let's say over the past 10 years, but not one snapshot moment, but say in given 3 or 6 month periods.
So how would your standard 401k investor access that kind of information? Where would they go to find out correlations like that?
They can find that from the returns. If they can get historical returns, whether it's on individual
Just take a
market.
look at them and see. Just you could eyeball and say this goes down when this goes down, and it goes up when this goes up.
Yeah, or if you have the actual, let's say, monthly returns,
Mhm.
whether it's of an individual fund or of individual stocks, and say, okay, I have 10 years of monthly returns of these two investments. You know, you can just then look at it and say, well, how have they done over time?
Mhm.
Do they tend to really move
In
in
the same
tandem?
direction,
Yeah.
right. So if you, again, if I'm thinking in terms of individual investor, so I found out that a bunch of things are correlated. And actually, I read something recently about investing in mutual funds and even exchange traded funds, ETFs, that you need to know what those funds invest in, because you might be putting a whole lot of money into the same stocks. You think you're diversified because you own a bunch of different mutual funds, but they're all investing in the same thing. So you're not really diversified at all.
Years ago, I had a friend of mine who was being advised to invest in a lot of mutual funds. And I said, take a look at the top 10 holdings of each. I think he had like 30 or 40 different mutual funds.
Mm-hmm.
So look at the top 10 holdings of each one and see how different they really are.
Mm-hmm.
And I think he came back at a later time and said there was actually a lot of similarity, that he was actually getting a lot of exposure to the same stock through
Mhm.
multiple
Multiple
funds. Yeah, so that's something you have to, you know, you have to look at. Do your research, do your due diligence.
And I think, that's something I'm glad you mentioned that, because I think most people who invest, they trust other people to do this for them, and they feel, oh, I'll never understand that. That's way beyond me. And maybe even some of the things we've been talking about here, we may have forced many listeners to tune out by now. We don't know. But there really is a sense of personal responsibility in this as well, right? You have to understand what you're doing and why you're doing it. Is that kind of like a cardinal rule of investing?
Ultimately, you should. Yeah, you should understand, you know, what am I investing? I mean, you don't necessarily have to know all the great details to it, but generally understand it, you know, what it is. And what's the purpose of it? Why do you have it in your portfolio? What goal does it serve? What are you trying to obtain with it? And what's interesting too that I've found, coming back to alternatives, is that it used to be years ago where investors would just kind of take hedge funds, just, you know, one big category, and just say, yes, I'm diversified, I've got hedge funds, and just leave it at that. Now what I'm seeing them do is they're starting to parse it up strategy by strategy and say, well, which ones actually work for me and which ones don't necessarily work for me? You know, once again, what's my goal? What am I trying to do? Am I looking for more returns? Am I looking for a shock absorber? What's the reason to have this in the portfolio? Not just to have it in there, but you're trying to diversify, you're trying to reduce your tail risk or correlation risk. And so do these investments help me to do that?
And one of the things I think is interesting, we've been talking now for 25 minutes almost on investments, and the subject of the actual, like take an equity stock, the actual company that's underlying hasn't really even come up. We're not talking about, are you investing in Microsoft because you believe Microsoft is a great company? We're talking about something completely different here, right? I mean, not that that doesn't matter, but when you talk about why is this in my portfolio, it might be because I think Microsoft is a great company, but it might also be because I want an established, large cap stock that doesn't have a lot of volatility and that pays dividends because I want that income. Is that the kind of thing we're talking about, knowing that as well as the fact that I like this company?
Sure. I mean, if you're looking at individual stocks, you can do that. If you're looking at alternatives, then you're probably more likely to be looking at managers.
Okay.
And understanding what the managers are doing within their portfolio. What do they have in there?
Managers and strategies, right? What are they doing and why are they doing it, and who are these guys anyway?
Exactly.
Right.
Yeah, and that's part of what I teach my students too, how to do due diligence on the managers, so that by the end of the 10 weeks, they can express their opinion whether they like or dislike a manager. Are there red flags? Are there things that they they like about it, but yet there's still something about on the negative side. Go, okay, I'm weighing the two between positive and negative, and going, you know, there's some things I like, but there's enough here that I dislike that I'm going to say no, thank you.
You know, recently I had on an angel investor here who was talking. We were talking about, well, how do you figure out who you're going to invest in? And he said it's the people.
Yeah.
I invest in the people. He said the idea, yeah, I pay attention to that, but mainly it's the people. So that sounds like what you're talking about. If you're looking at hedge funds or alternative investments, you want to know who's doing it and what's their record and how well can I really trust them to know what they're doing.
Yeah, that's definitely part of it. So you want to understand that side of it, right? So there's what's referred to as the front office, which is the strategy, the portfolio, the research, and then the what's referred to as the back office, which is the operations, who are the people, you know, what's their background, you know, their history, who are their lawyers, accountants, all those, you know, the people who are taking care of the
Running the
operations.
business.
Yeah.
Right.
And is this someone who's had experience in this business, or did they just wake up one morning and say, hey, I'm going to start a hedge fund and let's see what happens?
Yes, I looked up this guy and I thought, I am a hedge fund manager.
Yeah.
There's no Mel Brooks bit about that. It's slightly different. So is this the kind of research that your company does to figure out who are these, what are these alternatives? What do they look like? Who's the management? What's their track record? Is that the kind of research that you're engaged in?
So part of it is on the managers, part of it is also on individual markets, like on the futures markets, and looking at those and some of the strategies involved with that, and what's the behavior of those as well, how does that fit in? And then at the higher level, the more macro level, is asset allocation. You know, making sense of this as to, okay, going beyond stocks and bonds, how does this fit into a portfolio? So, and thinking about that, and with that too, understanding what's the risk that's there. And, you know, if you think about too, what people talk about risk, they often think about standard deviation or volatility. What I like to say is volatility is like cholesterol. There's good volatility and there's bad volatility. The good volatility is when you're making money, on the upside, right? The bad volatility, the negative volatility is when you're losing money. If you think about a lot of times in the news, they often, when they're talking about equities, they don't talk about volatility unless equities are falling. However, when equities are rallying, that's still volatility. It's upside volatility. I mean, I would take that every single day. It's the downside volatility investors get worried about, you know, and they're sweating in the middle of the night. And,
I've had those moments, by the way, just so you know, right?
but and that's what, you know, everyone is really concerned about, right? It's that downside volatility. It's not the upside. So you have to kind of parse those apart as to where is your volatility really derived from? More of the upside or more of the downside?
But that's unpredictable, or is it unpredictable? I would think that, you know, anything can go bad, things can change. So how do you know, I could say, well, obviously I want upside volatility,
Right.
and I don't want downside. That's easy. But how do I correlate, how do I turn that into actual action?
So what you have to do is look at the returns of that investment and say, okay, historically, what has it done? Has it been more upside, more downside, or, you know, has it been more normal distribution, the so-called, you know, bell curve that everyone is familiar with? A lot of investments tend to either be more positively skewed, either more to the upside or more to the downside, negatively skewed.
So believe it or not, we're out of time already.
Oh.
And I'm just going to have to take your class at DePaul because I really want to know
Please.
more about this.
Come on in.
So Mark, thank you so much for being here. I appreciate it. I've certainly learned a lot. Thank you so much for being my guest.
Thank you very much.
And thank you for joining us once again on Public Perspective. I hope you learned as much as I did. I'm Kevin McDermott, your host. You're watching Public Perspective, and you can see us every Saturday night at 8 on Comcast Channel 19. Find us on the web at publicperspective.tv. So until next time, thank you and good night.